shift.
Something's,
So,
it's very angry.
yeah, yeah, that's just.
Record everything.
All good.
We record everything and come on in, Serenity, come on in.
One of my favorites.
Yeah, she's coming in. Come get a seat. Oh, we're filling up online. Good deal. Yes, we are. So here's what we're doing this morning. I'm so glad you guys are tuning in. I'm so glad you read the group me when I said you don't want to miss this. We've got Stephen and Serenity in person, and we're gonna be talking about loans. So here's my 2 cents. As an agent and as a coach, you don't have to be an expert in loans, but you have to have base knowledge. And then you have to partner with experts. Because it does make a difference. You all might not understand this because you haven't had that much experience with loans. With lenders and transactions and what have you, but, there are good, bad and ugly lenders. And loan companies, just like there are agents, just like there are title companies, just like anything out there in the work world, there's good, bad and ugly, okay? Here's what you have to be careful of, and I didn't understand in the beginning as a new agent. I thought, well, they're all professionals, these lenders, they know what they're doing. It doesn't matter who my buyer's using. And then I had some experiences that changed my mind. I had one of my buyers work with a lender that had her so paranoid and afraid that she wouldn't get any second opinions. I even ran her numbers to our in-house lender. Our in-house lender could have saved her over $2,000. But this lender had her so brainwashed, saying, well, this is gonna hurt your credit. Nobody else, you're just lucky I can find you a loan. Nobody else is gonna be able to find you a loan. He was in her ear with brainwashing the whole, I didn't know that all lenders don't partner well with agents. And they don't, and here's why. Here's what I learned is they're afraid that if they're a high fee and that type of thing, they're afraid that you as an agent are gonna try to get your client to get a second opinion. Well, yeah, duh, that's our job, to help make certain that we're helping our clients get the best loan for what they're trying to get. And so this lender didn't have on closing day, still didn't have numbers to the title company. The buyer is calling me from the bank saying, I don't know how much to take. I don't know how much to bring. I don't know how much to bring. And I'm like, and the title company didn't know either. So I go into the closing. The title company's like, haven't heard from the lender. Actually, it was in the parking lot. Somebody pulled up right next to me. And he got out. I swear he hadn't been to bed the night before. And I'm like, I bet this is the lender.
Maybe he was starting a company. I mean, come on.
Well, and here was the kicker. His fly was down.
Oh, God.
And I'm
There you
like,
go.
okay, this is describing my whole experience with this unprofessional person. And I'm like, are you so-and-so? And he goes, yeah. And I said, we don't have numbers, because I know we don't have numbers yet. He wouldn't let me schedule the closing. He yelled at me about that. I mean, it was a horrible experience. But my buyer it was her brother's buddy, right? And I didn't know that I should be advocating for second opinions.
Right.
I even came up with a script for that and say, I ask all of my, it's great that you got pre-approved Serenity before we met.
Yeah.
That shows that you're trying to do your due diligence and be prepared. However, I ask all of my buyers to get a second opinion.
Yeah.
And here's why. 2 reasons. One, I want to make sure you get the best loan product for what you are wanting to accomplish. I don't say the least expensive, because that's not always
Right.
the best for them, right?
Yeah.
I want the best loan product for you, and Two, I want a backup plan, because I'd love to tell you every lender can get you to the closing table on time. That's just not true. And if we get 10 days out and our world's caving in because the lender has dropped so many balls, I want to have a backup lender that we know can take that file and run with it and get us to the closing table. And 95% of my buyers would get a second opinion because I prepared them in the beginning saying, here's why we do this.
Yeah.
And that takes me to why we're here today with Jason and with Shane. If you guys would introduce yourselves and just a little background on you, and then get to sharing
How
about
many people we
loans.
got on the call?
We've got 1, 2, 3, 4, 5.
And are they allowed to answer questions? Can
Yes.
they- Can they speak?
Yes, they
And
can
they
speak.
Cool, cool.
No, we don't let them
We're
talk.
not muted.
They are muted, but they can
Okay.
come on and talk at any time.
Okay. We'll have this more kind of,
But you're on
Interactive,
camera and they
informative.
can see you.
yeah.
Oh,
Hi.
Oh,
Sorry.
I was totally picking my nose the whole time.
So Jason Larkins, Executive Finance Manager, Loans and KC. You know, been mortgage business for 11 years, originator for 7 of them, closed about 700 loans in that time, and then been in multiple levels of management for 4 years, from team lead, which is basically managing a small group of newer and semi-experienced loan officers in the national mortgage lending space, and then the sales director for a large startup, for a large company trying to start up a national mortgage lending division, and then opened my own mortgage branch for a period, and then came here. Formerly, before that, I was a financial advisor and a Dave Ramsey certified counselor, so I'm a massive finance nerd and a numbers nerd, and it's just kind of what I am in life. It's what my brain thinks about, and it's what I'm good at. And this is
Well,
Mr.
that's
Dane.
really hard to follow up. I don't have near that many accolades, so.
Not yet.
But, the simple portion is I have a customer base background. I actually worked the same spot as Jason did a few years ago in the consumer direct market. So we've got to see both sides of actual lending, broker, consumer. You don't want to get too in depth with that stuff, but I'm going on my 17th year for originating loans. And that's really the simple portion. Like I said, my focus is customer base, make sure that the customer does get the best possible deal and service that they deserve. So that's pretty simple.
Awesome, awesome. Well, gentlemen, you're here to educate new agents about loans. So like I said, they don't have to be the experts, but they have to have some base knowledge because they're gonna get questions about, oh, and you need to know what's a VA loan, what's a FHA loan, a conventional, just those things that you as a lender say, okay, here's what you need to know when you're new.
Yeah, so I'm gonna kind of first piggyback off of your intro.
Yeah.
And some of the stories that you're sharing. I'll explain a little bit about our company. Is that fine?
You
And
go for it.
then we'll get into mortgage 101.
Good,
So I think Kristen did a pretty good job of hitting on.
pretty good.
Fantastic job.
Fantastic job. No, I think,
Tough crowd.
I think as you guys, I mean, depending on how many deals everybody's done, you know, as you experience different loan officers out there, there is a very wide range of ability, of knowledge, of patience with a customer, of education with the customer. There is a very, very wide range. And so you do have some lenders that will freak them out about multiple hard credit inquiries and those sorts of things, right? They will intentionally, it's a sales tactic,
Yeah.
right? It's a sales tactic to scare somebody to not go get multiple hard inquiries because you don't want to get your credit score dinged multiple times or whatever the case is, right? So just for everybody's knowledge, it's a myth, right? So the actual data, FICO doesn't release any of their information, right? Nobody precisely knows exactly how their algorithm is and exactly what, you know, they are looking at. But it is either 15 or a 30-day window that you can shop multiple mortgage inquiries and you can have multiple hard credit inquiries, and it's only the first one that actually dings your credit. Now, for Fair Credit Reporting Act, all of the other credit inquiries still have to be reported. You still have to be aware of who has pulled your credit. but it doesn't actually ding your scores any further. What I've seen in my career though, and this will kind of confuse a borrower sometimes, is let's say Shane was working at a different mortgage company and he pulled credit last week on a client and Shane saw a credit score of 720. This week, you know, you maybe send the client to me and I pull credit on them. I could possibly still see a lower credit score because if anything has been updated on their credit report in the last week since the time Shane pulled it versus the time I pulled it, I may still see something different. And then the client was like, well, my score was 720 last week. Somebody told me that it wouldn't have multiple dings on my credit score. I'm like, well, it doesn't, and it didn't. Something has
Something
been
else.
updated since then, right? So they can absolutely have multiple credit inquiries and it will not ding their scores. And then kind of speaking to just, the sales tactic of loan officers out there. I hate salespeople. I'm an educator and that's how I've always based my business. That's how I've built my career. I strive for my team to be similar to that, and the team that we build out here will be kind of required for that. But, most loan officers don't provide their clients a detailed breakdown of payment, cash due at closing costs, prepaids and escrows. Most of them do not provide something like that when they pre-approve a customer. Okay, so most of them don't. So sometimes the client is literally gotten pre-approved, but they don't know what payment to expect and they don't know what cash due at closing to expect. And so if you're working with a loan officer that does something like that, it's much more likely that once they get under contract and see a loan estimate, and you very well could have a deal fall apart right out of the gate if the loan officer didn't do a decent job educating up front, right? What we will often see too, even if a loan officer does provide the cost detailed breakdown, and I'm going to use a specific example. There was an agent in this office that works on a former coach's team here that got a quote from a very popular mortgage broker that is used by some of the launch agents and some of the people. She sent me that person's loan estimate. So he didn't have a cost worksheet. She wasn't under contract yet. It was still a pre-approval. She sent me his loan estimate. He estimated 0 days of prepaid interest. So it's one of the prepaids and closing costs category. And prepaid interest is a fee that you pay based on the number of days that are left in the month after you close. Well, 0 days literally means you would close at the very last day of the month, which that wasn't determined yet, right? But if you close earlier in the month, you're going to have a significant number of days of prepaid interest. And that line item can literally range from $20 to $2,000, depending on your loan amount and whatever the case is, right? So a lot of tricky loan officers that want to make their numbers look good up front to somebody will really lowball prepaids and escrow deposits and prepaid interest to make their numbers maybe look better than another lender if they know that they're comparing them or whatever the case is. And so I always use 15 days of prepaid interest because it's smack dab in the middle, right? And I educate my clients on that. Hey, if you close later in the month, this line item will be a little bit lower. If you close earlier in the month, this line item will be a little bit higher. And it's just, you get that stuff. So even the loan officers that may provide something up front, a lot of them will still just do things that aren't the best, right? They've underprepared the customer for the reality of what likely will be due at closing. And so hopefully the person has the cash. If they don't though, and costs come in $1,000 higher, I mean, you could have a problem towards the end as well.
Yeah.
And so it happens all the time. Finding somebody that you can trust is very important. So, getting into our business and Loans and KC. So do any of them know? I mean, most of the ones in the office know. Do the ones on the call know that we're kind of the
No,
new in-house lender?
We have some brand new people on, so.
Brand new. Okay. So Loans and
Yeah,
KC. So we are technically the in-house lender now here at KWKC Metro. We are also owned by agents here at KWKC Metro. And so it's a pretty cool business in that some of you on the call, if you guys are here for a couple of years and are successful in this career, you can eventually buy into the company and have ownership percentage in the company. And it is pretty neat, but we are a traditional mortgage brokerage shop. meaning that we are the loan officers, we're the front end person, we're the point of contact for the customer from start to finish at the end of the day, but we're always in a mortgage brokerage, we get to shop multiple different lenders kind of on the back end to pair the client up with either maybe the best price, the best rate, depending on their scenario. Maybe it's a lender that we know can close fast. Maybe they won't have the best price, but we know that they can close quickly. Like, you know, the largest lender in the nation is called United Wholesale Mortgage, and they're notorious for closing quickly. And so I think our average clear to close timeframe for those guys is 10 business days, 10 business days right now. And we've had a lot of files with them. So there's some lenders out there that can close really quickly. There's some lenders out there that are very competitive in rate. There's some lenders out there that have unique products. And so we're able to kind of shop all of those and try to get our clients the best deal. Whether that's rate, whether that's best, what did you call it earlier?
The best loan product for
Best
what they
loan
want to
product.
accomplish.
There you go. Perfect. That's how, Steve, you did better than I did.
Yes.
Well, I've been doing scripts for a while. on this.
I'm still lacking sleep because I party all night long and go to
Well,
closings with
we-
my side.
Yeah.
Till-
13-hour days.
Yeah, we did a long one too, so we feel you.
But yeah, so we are here in the Prairie Village office. My office is down the hall. Shane is he's also in this office, and then he's also supporting.
He's directly across from me.
Yeah.
Yeah, but yeah, so we're here, we're the local lender, I guess, but then in addition to that, you know, we have a little unique thing where after you're in the business for a couple of years, you can possibly have some ownership in the company and buy into the company and that sort of thing.
When he said that, I want you to understand that, as far as I know, we are the only office company in Kansas City that has an agent-owned mortgage company. And that's pretty amazing, because I will tell you, as an agent, you should have multiple streams of income. And so being able to invest in a mortgage company and reap the benefits as they become profitable, it can be an additional stream of income for you. So, I know it would be a little bit before you would be eligible, but I want you to keep this in mind, because it should be a goal of yours to be an investment partner, because you don't have this opportunity other places. And we're always looking at ways to help our agents grow their income, and we're always best being diversified.
Yes.
Just so everybody knows, it's 2 years is kind of the first level. So 2 years as a licensed real estate agent, and then there's different tiers based once you get beyond that. The thing that I will add to before we kind of hop into mortgages. So for now, we launched loans in KC March 26th. I've been here for about 4 months now. My plate is very full, and it has been, Shane's on board now and been here for a couple months, but it is very much the Jason Larkin show. And I think what's important for everybody to know is that that's not always gonna be the case. Serenity even knows, like, poor Serenity.
Shane's my guy. I love you, but I'm trying to implement what you want.
No, he's got a full plate. I'll,
So Shane,
Okay.
Shane will be a good contact for everybody for right now until I lighten my load. I think what I want everybody to know, though, is I do believe that I will have a loan officer that is targeted to new agents, to the launch program. They might also do some outside prospecting and those sorts of things. And I don't think we're probably too terribly far away from that. It might be a younger, less experienced loan officer, but it will be somebody that I take under my wing and kind of craft them into what I want them to be. But that will be a really good fit for somebody that's hopefully maybe single, no kids, can go to open houses all the time, can work their life away for a minute, and me, I cannot handle all of it right now. So, but that is the plan. So just know my plate is full, and if you try to get a hold of me, feel free to try to get a hold of me. You know, it just might be a little while for me to respond.
You'll have much better
I
luck.
try.
getting ahold of me.
Yeah, I try. I try to.
And that's okay.
Yeah.
We're in startup mode and they're doing a phenomenal job. You're closing how many in June?
8 or 9, depending on
8
if
or
loan
9
closes today.
deals. And then you said for July, like 16.
16 should be for July if everything closes.
So we're
Yeah.
exceeding
We're for
projections
sure
as a
exceeding.
startup company.
Yeah.
That's pretty awesome.
Yeah, we'll be profitable probably back-to-back months and this early is, which is, I mean, you just don't see
Unheard
that.
of, yeah.
Pretty unheard.
All right, so mortgage 101. Now we're gonna open it up. Okay,
Mhm.
let's hear. What are the 2 most common loan programs in the country? Who knows that? What are the names of them?
FHA.
Okay,
Yeah, Freddie Mae,
I do that too.
Yeah. Fannie Mae and
Freddie
Freddie.
Mac. Okay,
That's my guess.
so all right, so we got Fannie Mae and Freddie Mac, which are basically the backers of conventional loans, right?
Okay.
So they are government-sponsored entities called GSEs. They used to be independent companies years ago, but after the crash, they kind of got supported by the government. So now they're called government-sponsored entities. And they are the backers of conventional loans. They make the guidelines for them. They create the secondary market where conventional loans can get transferred and sold. Because mortgages are basically a commodity now. So conventional loans make up 78% or so of mortgages in America. They are by far the most common loan program out there. And the reason for that is they are the better loan option financially for people with above average credit. It's also the only loan program that can be utilized for second homes and investment properties. There are some kind of portfolio type products for those, but the other traditional loan programs do not allow second homes and investment properties. So conventional loans are the only ones that will allow that. And then FHA, Serenity was right. FHA is the second most common loan program in the country, which is around 8 or 9%. And so there's a huge drop off, massive drop off to the percentage that goes FHA. Then you have VA that's right behind that, which is exclusively for veterans. And then you have jumbo loans and then USDA loans way at the bottom. And so we'll get into all those sorts of things. All right, so let's talk about conventional loans. Who knows what the minimum down payment is on a conventional loan?
Okay, you all online also don't think that I'm not watching to see if you
Yeah,
have
let's
any
go online,
questions.
people.
I put 3%.
That's
on
what I'm going
ours,
for.
But, I mean, if there was lower, I didn't know.
You'd like to
I
know.
would have liked to know.
Dominic is saying 3%.
Attaboy, Dominic. Yep, so 3% is
Serenity too.
the right answer. So I think conventional loans can get a little confusing because there's kind of 3 pillars. There's 3 categories underneath the conventional loan umbrella. And so you have the non-first time home buyer option, which the minimum down payment is 5% on that one. So a non-first time buyer, 5% minimum down payments. Then they have the first time home buyer program, which is a 3% minimum down payment. And then they have their income-based program. The income-based program doesn't matter if they're first-time home buyer or not. They can have bought multiple homes, but if they qualify, if their income is below a certain threshold, they qualify for the income-based program, and that is also 3% down. And that is by far the best conventional loan program. There's a discount on the interest rate. There's a discount on the mortgage insurance, or the PMI. And so the income-based program is always the route to go if we can do that. It's called the Home Possible or Home Ready program. So Fannie Mae's is Home Ready, Freddie Mac's is Home Possible. And the guidelines are all the same otherwise, right? So it's just an income restriction. And basically what it is, it does change by county technically, but you have to be at 80% or below of the area median income. So for Johnson County, I think it's 80, and I think Jackson County may even be the same, but it's $83,000 a year right now. So any income that the lender is using to qualify somebody, that has to be under $83,000 a year.
Income base.
Yep, income based.
It's the same in Wyandotte County?
I can verify.
Say that
It's all the
again.
same though,
What's
in the
the
metro area.
Okay.
And
all
I
the
just
same.
saw this.
83,000
83,000?
a year. It
For
has to be at-
income
it has to be at 80% of the area median income or below.
80%.
Did
And
it
that-
recently go up?
It
has
goes pretty
gone.
much every year,
Okay.
yeah. So every year they kind of reassess that data and change
You
that.
mentioned PMI too. Maybe just check what that is. Okay.
One
We're
step at a
just
time. We're just talking about down payment. Just talking about down payment. We'll get to all the different.
You've got speaker? Enthusiasm here.
The technical sides.
So you have the three different the categories, the income-based program, 3% down first-time home buyer program, 5% down traditional option
Yeah.
for non-first-time buyers that don't meet the income restrictions. Those are the traditional options. Now, you can find lenders out there. There are sometimes options where you can maybe get down payment assistance or possibly a grant to help you cover some of the down payment. And those are hit or miss. Some of them are there's some local lenders that have very location specific grant-based programs. And so oftentimes they have to be in low or minority census tract areas. And so it depends on the location of the property. Sometimes there's minimum credit score requirements that are above even the loan program requirements. And so there's just there isn't a black and white solution to those, right? It's very specific to somebody's situation.
Yeah.
Serenity, I talked about this in the business meeting on Tuesday, but we do have a solution where there is essentially a no money down conventional loan option. So it's a 3% down conventional loan. They do have to be at 80% of the area median income. I'll clarify that because anybody that was at the business meeting, I said something different on Tuesday. So they have to be at 80% of the area median income or below, but they can get a second mortgage, a loan for the 3% down payment. And the benefit, it's called a soft second mortgage, meaning that there's no interest and there's no payment on that second mortgage. So they do owe the money when they sell or refinance the home one day. So they are taking a loan for that down payment, but there is no interest and there is no payment on it.
Okay, the reason I just paused is because when I was a new agent, that was a common thing, but it wasn't used well.
Yeah,
It was not used well. It was more of a hidden loan.
so this is
And it
not,
was a lot of times not recorded. It was mortgage fraud that was going on.
they call those silent seconds.
Yeah, the silence.
Yeah.
And it's part of what got us into the downturn in 2007. So it got my attention when he said that, but now I get how this one works. It sits there
It's there, it's a recorded lien on title, yep,
and it is due when you sell,
balloon payment.
but
upon
it's not
refinance.
adding to your monthly.
Correct.
That's sweet. Okay.
Interesting.
Yeah,
Okay.
pretty cool.
Okay.
So what I try to educate people
Learn
too, and
something.
again, just being an educator, so at the business meeting, just for clarification for anybody that heard the business meeting, so this program was also available for first-time buyers with above 700 credit with no income restriction. They literally pulled the plug on that yesterday. So, so that portion, literally yesterday that happened. They pulled the plug on that. So now it is only got to be at 80% or below the area median income. What I will say though, and again, just educating, it's very rare that any of these down payment assistance programs that you ever get anything for free, right? Like most of the time, if you have your own money to do something, it's typically best to go that route.
Always.
So I worked up this no money down option and a 3% down traditional option for a customer last night. And the traditional option with the Home Ready program, income-based program, the rate was at 6.99% with no points.
Okay.
The no money down option was at 7.5%. So there was a 0.5% adjustment in the rate. Now, that doesn't mean this person shouldn't do it, especially if they don't have money, right? If they don't have money, it's still not a bad option because he was looking at a $200,000 house. The total payment difference, even though the rate was 0.5% difference, was $70 a month. Well, all right, is it better then to wait to buy a home until I can do 3% down, or should I buy a home now if I can get an offer accepted, right? And maybe take this higher rate with the higher payment. In my personal financial, opinion, if debt to income ratio is okay, if they're not totally strapped, right? Like because we all know repairs happen and all those sorts of things. So if it's not just a terrible decision for them, Well, if home values appreciate at 3%-ish on a $200,000 home, they're gonna be making $6,000 a year in appreciation on the property. And they're only paying $840 a year more because of the interest on the home. And so financially speaking, they probably will come out ahead, even though the rate may be a little bit higher and those sorts of things. But if those same two people had the option to put 3% down and had the money to do that, or could get a gift from a family member to do that, then they probably should go the 3% down without the loan for that, right?
Mhm.
And take the lower rate, and then they're winning everywhere. But for some people, it'll still make sense to do that. Okay, so what is the minimum credit score required for a conventional loan?
Anybody? Online?
I'm guessing.
Online audience?
6 something.
That's 600 to 699. We need to look like.
You're saying 650?
Dominic's saying 620.
Boom, dude, this man, this man.
He's Googling the answer.
I don't know.
Minimum credit score is 620.
Minimum credit score on a conventional loan is 620.
To qualify for any of these tiers?
Any of them, yeah.
Okay.
The three?
Okay.
All three of them,
Okay.
the same guidelines overall, same debt to income ratio requirements, same everything.
What's the debt to income?
What?
Yeah.
Skipping ahead.
Question.
The great question. So just so everybody understands too, so on mortgage lending, the lender has to pull all three credit scores of a customer. So you have Equifax, TransUnion, and Experian.
Right.
The lender throws out the high score and the low score, and it's the middle score that's the qualifying score.
Okay.
That's the score that matters.
Okay.
If there's multiple borrowers on the loan, no matter how many borrowers are on the loan, it's the lowest person's middle score
Okay.
that counts. We are starting to see, this is gonna be a slow adoption, it's gonna take some time. We are starting to see Freddie Mac particularly be okay with like a blended credit score to maybe get the qualifying score up higher. So if you have somebody at 600 and somebody at 700, we might be able to factor like a 650 to get them above the 620 to qualify them.
Mhm.
But then the interest rate will be based off kind of the lower credit score. There's some very slow adoption that will be starting to happen and starting to roll out. I just got an email from Freddie Mac like a week or two ago about something along those lines.
Okay.
But until it's like massively common, like you just won't hear about it or see about it much at all. Because the lenders that are gonna be able to like be willing to do it, they probably will charge a premium because they're doing it, right? And nobody else is at that point. So the deal may be more expensive, the rate may be more expensive. And so until it's widely adopted, like you won't probably see really good rates and that sort of stuff for them. But 620 is the minimum credit score requirement. One of the downsides of conventional loans, though, is that it's very, very credit sensitive, exceptionally credit sensitive. The income-based program is less credit sensitive, but the other two are highly, highly credit sensitive. And so from a pricing standpoint, from a rate standpoint, there are breakpoints in pricing every 20 points. 620, 640, 660, 680, 700, 720, 740, 760, and 780. The final break used to be 740 about a year and a half ago. But they just changed that to where they added tiers at 760 and 780 now. And so in order to get the absolute best rate you can get, 780 and above for that middle credit score is where you have to be. One of the downsides of conventional loans as well is the mortgage insurance is also very credit sensitive, the PMI that somebody pays. And so PMI,
What is PMI?
well, yeah, we get there. That's what Shane wanted me to hit on, and then we'll get to debt to income ratio. So just to finish the point about PMI, so we'll get to exactly what it is, but it's based off of credit score, debt to income ratio, we can talk about too, and loan to value, their down payment percentage. So what is PMI?
Yeah, what is that bad boy?
I don't know. Let's have somebody answer that question.
Okay, anybody know what PMI is?
Megan,
It is mortgage insurance that you pay until you hit 80% value on your loan, and then it goes away.
why does it exist?
Probably because of problems in 2008.
Well, it's been there a while.
So, yeah.
But
Yeah.
I mean, I don't, but
It became more popular because like it's so a lender
way to
kind of
protect
had
the
verified a while back that there's a certain percentage that they lose when they file, go on foreclose on a property, right? So between attorney's fees, evictions, paying realtors to sell the home, fixing up the home, to sell the property quickly, all those sorts of things. So on average, a lender will lose 20% value when they foreclose on a property. And so on a conventional loan, if you don't put enough money down, you are literally buying an insurance policy. The client is buying an insurance policy that will pay a portion of the value of the home to the lender if they default on that loan. So it's no benefit to the borrower. Like there's not a benefit, it's a waste of money. There is no benefit to the borrower, but it is just protection for the lender. And so Megan was right. There is on conventional loans, if the client can put 20% down, that's when they don't have mortgage insurance. And I think the other thing to note that a lot of people don't know is that there are breakpoints. So I said, so it's based on credit score, debt to income ratio, and down payment percentage. And there are very significant breakpoints in them at 10% down and 15% down. So this will get kind of complicated, but basically on the income-based program, the PMI is always pretty dang low, unless they just have really bad credit or something like that, right? So the PMI, again, very reduced because of the income-based program. On the first-time home buyer option though, very credit sensitive, all those sorts of things. If the first-time home buyer puts 3% down, they're taking a slightly inflated interest rate and they're taking a slightly inflated mortgage insurance. So if that first-time home buyer put 5% down, they get a little bit of a discount in the mortgage insurance and that sort of thing. And on the first-time home buyer program, and all three of them really, you just don't see it as pronounced on the income-based program. But on all three of the programs at 10% down, there is a discount. There's a change in their calculation, the percentage that they charge for it. At 15% down, there's another change in their calculation. And then at 20% down, it goes away completely. So when I talk to customers that have options, I literally talked to somebody the other day, a lead from Kyle Talbot. And that person wanted to just see all of the options, right? So I showed him a 5%, 15%, or 10% and 15% down option, so he could visually see the differences in the mortgage insurance and how it changed. Not only his loan amount and his payment because the loan amount was cheaper, but also how the mortgage insurance changes as he puts different percentages down. And so when we may talk to a customer that maybe had 20% down, I very well will show them a 15% down option because I want them to see, right? Hey, you can save $10,000-$20,000 out of pocket and add $20 a month to your to your payment because of mortgage insurance. And so mortgage insurance doesn't always have to be as expensive as some people think. It can get very, very expensive. Lower credit score, higher debt to income ratio, whatever the case is. Shane had a deal a month ago, a couple weeks ago, literally the PMI was $400 a month. $400 a
In
month
addition to.
Conventional,
on a conventional loan. And so again, conventional, very credit sensitive, not only in the interest rate, but also in the mortgage insurance calculation. And so depending on that person's credit scores will really dictate maybe which option, which loan program will be the best. All right. Is that good on PMI?
Yes.
Yeah, so again, here's what I want, because I'm sure it's making some of your heads spin, right? It's a lot. It is to give you an idea of that there are a lot of options. Again, this is me, because he may or may not say it. Don't you try to explain it to a consumer, a buyer,
Oh,
okay?
yeah.
Oh, I
Please-
wasn't going.
Serenity's got it, but sometimes, I really struggled as a new agent, I thought, well, no, I have to know all of this because your buyers will ask you lending questions. They will ask you loan questions, and I thought, well, as a new person, am I supposed to know all of this? And so I felt that my newness was showing. But what I learned is, no, I don't have to be the expert. I have to associate with experts. And I would say, you know what? That's a great question for the lender. Let's get with Jason.
Yeah.
He's the one who's the expert. I know I have, general knowledge of loan, but I'm not the expert. That's why you're gonna ask that question of the expert. And that took such a load off of me as a new agent to think, okay, I don't have to know all this, thank God.
Oh, it changes so often.
Yeah, well,
We're not gonna be able to keep up with it.
Yeah, and see, he knows what the changes are, but I've seen some agents try to be an inspector, try to be a lender, and don't stay in your lane and work with experts.
Let me piggyback off that too, because that's very important to know. You guys refer to us for sure. If they ask about rates and stuff, just refer, because our rates change
All the time.
all the time.
And it
Like,
depends what-
within minutes, it can change drastically depending on what's going on in the market. And we have an ever evolving financial system, right?
Yes.
You know, how much moves at night, so everything moves all the time, programs change a lot. I think Jason said it on the earlier, that zero down program, we just literally they just pulled out from under us. And we can't use it, so that's the kind of stuff that we have to stay up with, and that you guys don't have to know, so
Mhm.
refer to us.
Absolutely.
We can be the great resource for you guys on that part.
Lean heavily
Yeah,
this
please do,
direction.
Before we hop into debt to income ratio, so on the last thing on PMI, I think everybody should know on the conventional loan is it can eventually go away,
Mhm.
right? So once a customer gets to 20% equity in the home, there's two ways to get PMI removed. There's an automatic removal process where it automatically goes away, and then there's an early removal process, but just in the back of your mind, at once somebody gets 20% equity in their home, it can generally be removed. So whether that's they put 3% down or 15% down and started with it, doesn't really matter.
The question about that, do most loans have, most loans don't have the automatic removal.
They all have it. It's that date,
I
basically,
thought you always had to, normally
say,
have
we
to
just
apply
have-
to
so
have.
that's
it
the
removed.
early, that's the
That's the
early
early.
removal. Automatic removal process it's a date set at closing. That's
Gotcha.
based on 78% loan to value on the minimum payment structure on the amortization schedule. So they'll look at your 9 years ahead,
Say
and they
this
pick
is
the
when-
date, this is the date.
But if you're paying more
Yep.
every month or.
If there's home value, any appreciation in home value that you wanna factor, and
Yeah.
if any,
That's the big one.
balances you pay down, yeah, so that's the early removal, and that's the common one. Nobody uses automatic removal doesn't.
Just, this is a little off topic, but not really. This is a way that you can show value because our homes have been appreciating at such great rates.
Mhm.
Historically, it's 4% in Kansas City. It was historically 4% every year, was the average appreciation rate. Well, we've blown that out of the water. And a lot of people don't know and understand that with that equity, it could be the time to remove their PMI. And you can look like a hero in saying, hey, is it time to look at your equity and figure out if you can get rid of that PMI if you haven't? Those are ways you can look like heroes. Because you know these things, consumers don't.
The one thing I will say to that,
Mhm.
careful, is
Careful.
that know what loan program they got,
Yeah, oh, yes.
because if they got FHA, and we'll get into FHA in a second, it doesn't go away on FHA.
Yeah.
And so there was a staff member here, we were literally at wind down on a Friday. She's like, Jason, how do I get my PMI removed? And so we were talking about it, and I'm like, well, loan program, do you have an FHA loan or a conventional loan? She's like, FHA. And I'm like, you can't get your mortgage
Yeah.
insurance removed. So you have to know if you're gonna make that phone call, if you're gonna do that. Great advice to do that, but just you gotta know what loan program. they have.
Well,
So,
and say to them, I would get you with a lender to be able to talk about that.
sure, yeah, cause if you think they're at 20% equity and if they're in an FHA loan, you can refinance into a conventional loan,
And get rid
and get rid of it.
so they'd have.
Now, yeah, it depends kind of what the rates are and whether it makes sense and that sort of deal. If they've gotten a home recently and the rates are high, then it very well could make sense to refinance to conventional just to get the PMI removed.
Cool.
So yeah, that's income ratio.
Yeah.
My favorite.
I just texted my wife. To see if
We need to check on
PMI,
that.
she does all the money. So I was like,
Do we, don't we?
Yeah. It's
Good,
not.
good, it got you thinking. I
yeah,
love it.
So debt to income.
That's income ratio. So that is simply, it's a requirement on all the different loan programs. And it's essentially an analysis. It's ultimately what dictates how much of a payment and then therefore how much of a home somebody can qualify for.
Okay.
It is the primary driving factor. of how much somebody can qualify for. So it's simply an analysis of the gross monthly income.
Yeah.
So before tax income, before, health insurance, payroll deductions, federal or state taxes that are taken out, gross income. And then it's compared to the minimum monthly debt payments reported on credit. So not, a lot of people get very confused and they think it's their total debt load, the total amount of money that they owe. $200,000 of student loans or whatever the case is. It's not the total debt that's looked at, it's the payments on that debt. So it's a cash flow analysis essentially, right? So gross monthly income compared to minimum debt payments reported on credit plus the projected new house payment.
Yeah.
With property taxes, homeowners insurance, mortgage insurance, and any HOA dues,
Say that last part plus what?
plus the projected new house payment. And so as a loan officer, what we're doing is we're tweaking that projected house payment to really see what we can pre-approve somebody for, right? We're changing that purchase price or the loan amount, and we're changing, making sure we have the taxes as close as we can get them and the homeowner's insurance as close as we can estimate it. And we're just kind of finagling that number. And then that really tells us what purchase price of a home somebody can qualify for, or what loan amount somebody can qualify for, and then therefore what purchase price. I think the thing that people can get into, loan officers and, deals that can blow up on you and those sorts of things, like be aware of what type of property your client's looking at. If your client's looking at a single family home and the HOA dues may be reasonable, like nothing to really be too concerned about. But if a lender has pre-approved somebody for 200,000 and the debt to income ratio is tight and close to the threshold, if they haven't assumed any HOA dues and your client's going to look at condos or townhomes that have large HOA dues, you can absolutely have a deal blow up on you because the lender didn't make assumptions on HOA dues.
Right.
And if they're too large, it can really throw things out of whack. And so sometimes when you're making an offer, if you see something like that, maybe if the property taxes are way beyond what might be normal for that price range, or if there are large HOA dues, you should probably run it by the lender before you make an offer.
Yes.
Sometimes it matters, sometimes it doesn't. Really depends on that person's debt to income ratio and where they are. So on a conventional loan, the threshold is 50%.
Jeez. That's egregious, sorry.
David mentioned in the business. We won't go into
On
that
the conventional.
on a conventional. I'm 50%.
It's not wise, but it.
No.
Happens all the time,
Yeah.
every day, every day. So 50% debt to income ratio. So if you make $10,000 a month, we can attribute $5,000 towards minimum monthly debt payments.
Wow.
Whether that's house, car, student loan payments, credit card payments, whatever the case is. It's a high number.
Yeah.
Okay.
We have are you going to talk some more on?
Oh,
the-
if we have questions, I mean,
We have a
if there's
question
questions.
from Olgie.
Yeah.
Olgie, is asking, as a new agent, what are some red flags to watch out for when working with certain lenders?
Just
That's
only use.
limitless.
Yeah. Hey, yeah.
Oh, did we meet the other day at the?
To a happy hour.
Happy hour. Come on. Did we have a
Well,
great conversation?
obviously, I'll work with you guys, but just on the off chance,
I know.
just to know.
Yeah, no, just giving you trouble.
No, I know, I know. I won't ever have that
Okay.
problem because I'll work with you guys, but just in case.
Appreciate you. I don't know if the loan officer hasn't communicated with you at all, right? Like, even after like the pre-approval, like it's okay. Doesn't mean you need to scare your client and say, hey, you need to work with another lender. I haven't heard from your guy, but make sure you call the loan officer and try to have a conversation with them. Like, be like, hey,
As
what
soon
are
as
you saying?
you
'Cause
start working with that buyer and they say, I have a lender and I've been pre-approved, you need to call that lender, introduce yourself and say, hey, looks like we're gonna be working with the same buyer. I'm really excited. Have a conversation because it can give you a sense on how this lender's gonna partner with you.
Yep.
And some will partner well and some will not partner well. And I wasn't ready for that as a new agent. I thought they all wanted to help us. They don't. They're not all good partners. So you've got to be really careful and you do not, here's my biggest pet peeve. Do not wait to reach out to the lender right before, for the first time when you're ready to write an offer. Don't. You should have done it when you started working with that buyer and they said, because there will be times, oh, you're right. There will be times where a buyer is dead set on the lender they already are using, and sometimes for good reason.
100%.
And it's fine, but you do need to know that you are the one who has to start establishing that relationship. Don't wait for the lender to reach out to you. You need to be proactive. You need to see how well they're gonna communicate. Because if you don't, oh my.
Yeah.
If you're gonna ask for closing costs, how the heck are you gonna know what to ask for if you have never talked to the lender? How? You're gonna be making stuff up. And it could actually hurt your offer because your offer, you could be exaggerating the amount of closing costs, or you could maybe not be asking enough.
Right.
So don't feel like you have to be that one who knows. It's the lender.
The thing, so I think reaching out is great, because a lot of these loan officers may not reach out to you because they may have not have asked the client what agent that they're working with, or, you know, that sort of thing, so they may not have that, but as soon as you're aware that they've been pre-approved by somebody, like, you should reach out. And probably, Olgie, the questions that I would probably ask is I would probably specifically ask, hey, you know, what are you projecting for maybe total cash due at closing? Have you talked to the customer about the closing costs and prepaids? Have you given them an idea of what their payment's gonna look like?
Yeah.
If they say yes to all that, you're probably working with a, you know, competent human being.
Mhm.
Okay, just like, so
okay.
those initial questions to kind of weed out which ones are legitimate and.
Yeah, so I would really just try to get an understanding, what have they given my client, and is my client prepared for actually what we're about to do? Because if they haven't, like, client should run away from that person, quite frankly.
And here's another point.
Almost, or, I mean, at least you need to educate your client to make sure that they get something. And if they have no idea how much they owe, if they have no idea what the payment's gonna look like, most first-time buyers that we talk to are so far off on their payment expectation and the price range they wanna look at. It is very uncommon. 20% of the time, maybe, that somebody actually has a decent projection of what they think the payment's gonna run for a price range. So when I'm doing an introduction call with somebody, I'm always asking, what price range are you interested in? And it's followed up by, what payment range are you comfortable with and are expecting,
The
right?
most
I did
important
100%,
question
no
is,
question.
how much do you want? We get focused as agents on what they're pre-approved for. And you have to understand, well, yes, they're pre-approved for that, but where is the comfort level in the monthly payment? Okay, so to me, it's more important to ask buyers, how much do you want your monthly payment to be? Because that should drive the train more than the price, because they have a disconnect in their knowledge so often.
Yeah.
What were those questions again?
So I would,
know the payments.
yep, did you give them kind of a breakdown of what to expect for the payments? And have you talked to them about closing costs and their total cash due at closing? Because total cash due at closing is really kind of three categories. It's down payment plus closing costs plus your prepaids and escrows. And they need to know all of those things.
And depending on current
Right.
situations coming up, it could also be your buyer agency compensation.
Sure,
Yeah.
correct, yeah. I
So you
literally
have
got,
4 things to factor.
I got
in.
pulled into a conference room the other day with a client that I had pre-approved and the agent that they were working with, and they had asked me on my breakdowns that I'd given to them, had I included any sort of buyer agent commission, and I'm like, no, but if I need to, just let me know and I'll add it, but yeah, I had not factored that in there. So, but yeah, to know those things, because I mean, that's obviously important to your client, right? Like, and as soon as you're just saving yourself headache and heartache and saving them headache and heartache, if they haven't been given those things. And honestly, like, many loan officers will hide their numbers because they don't want people to shop them and compare them. And so they won't show them the rate. They won't show them these things. Like, it's very common for them not to get numbers from.
So basically, I'm a buyer. and I come to the lender and then they're giving me, if you buy a $200,000 house, this is what closing costs, this is
Yeah.
a range, right? That's what we're talking about.
Absolutely.
Have you given your buyer
A cost
these
worksheet,
ranges?
a cost worksheet. Have you given them a breakdown of what to expect for how much they're gonna owe at closing and the monthly payment and that sort of thing?
Loan comparisons.
Yeah.
Then you want to see that as the agent also. Don't just say, oh, great, thanks for
Right.
sending it to my buyer. I would like a copy, please.
Cause
Cause you need to know what your numbers are. that
Because
you're
we have to
looking
do that buyer's
at. You
estimated.
have to do buyer's
worksheet.
estimated, and you have to know if your client can afford the house you're looking at.
yeah, I just had somebody a couple weeks ago that was working with CACU. CACU has a decent no money down conventional loan type program. And it was a lead from Tammy, who's on the Thrive team. And, you know, I talked to the customer. He's like, oh, I got pre-approved for XYZ. And I was like, okay. I'm like, awesome. Did you get anything kind of, do you have any idea what the payment's gonna be hit? No clue, no clue. Hadn't seen anything. And so most lenders will just give that pre-approval letter. And they may mention something on the phone possibly about what a payment might look like or whatever, but they typically won't hand stuff out because they don't.
Wanna get
Wanna
tied
get
down.
They don't wanna get, yeah, they
Right.
don't wanna be committed to something or they, well, and we're not necessarily committed to anything because the rates will fluctuate. We
Right,
can't lock in the rates that are under contract. They just don't want it to be used as ammo against them, right? Like they just wanna avoid that at all
And
costs.
you
Let me
can't,
take you back to a little bit. So I do things a little different than a lot of the loan officers. And you guys will get a good feel for the loan officers. I mean, you guys are salespeople, you guys are kind of understand what's gonna go on. You'll get a good feel for your customer, your client. And then you're gonna talk to that loan officer. You'll know pretty quickly if this is gonna be a good fit or go well, right? You can get a good feel.
Yeah.
So I do things a little different. I literally just got the phone. I'll make this quick. They were actually, didn't know what their budget was.
Mm.
Or, let me be back, they know what their budget is, but they have no idea what that equates to in a value of a home, right? Because they don't understand what taxes and insurance, you have, oh, well, I know what this payment is. They go on Zillow. That representation on Zillow, and I'm gonna use Zillow in this particular case, it is always low by, oh, I would say what a percentage.
For what? Sorry,
So,
I'm catching
an
up. We're
average.
getting blown up over here.
Yeah, so just an average, I would say, a Zillow payment
their
on a
estimates.
proper, on their
Yeah.
estimates are at least 20 to 30% off.
Oh, well, just so everybody understands
Or-
too, so like it's a great conversation point with customers. All Zillow estimated payments, they all start with 20% down,
Yeah.
no mortgage insurance, all those sorts of things.
Yeah.
At low
Right.
APR.
So that's where a customer can often just kind of be browsing online, see the payment for a house.
So I
Or
can,
that.
Oh, this is awesome, like, right, I can afford that, but it's always 20% down, no mortgage insurance. A lot of times I've seen Zillow throw in some crazy low rates.
yes,
Like in their estimates, I'm like, that's not even fucking
That's
real.
fine.
Like, so, yeah, just.
so
yeah.
don't rely on Zillow.
Do not, 100% do not.
so what I did with this customer, right before I walked in here, is I got a lead, I talked to them, they wanted to know what their payment's gonna be. I'm like, okay, so if you gone to Zillow, you got that payment you get, right? And we had that conversation. So I'm like, well, let's go out into the world and see what a real payment on a property is. So I literally take them, I said, so what property have you been looking at? Maybe you're a little bit interested, you wanna go look at. I'll take them to that property, I'll pull that up, I'll pull taxes and insurance, and I'll give them a real-time payment based on estimated rate what is today.
Mhm.
Then they get a real idea of what a true payment is look like. Then they can actually go like, okay, this is my true value that I need to look at, my true purchase price. And
Mhm.
then we walk through down payment and then a possible cash close. Really, it's really simple, guys. It really is.
Mhm.
Our side doesn't have to be a big complicated thing.
Right.
We can make buying a home very simple, and that's really the goal.
Mhm.
As long as you're just upfront and honest with them, let them know where they stand.
Yeah.
I
Really?
have one more quick question. So sorry, I promise this is my last
No.
one.
Don't be
No,
sorry, these are great.
Ask them any
Um,
questions.
Appreciate it. I was just wondering, so also as a new agent, how do you kind of tiptoe that line of, as you had said earlier, you're not an expert in this field, so you're always going to be like, hey, let's talk to the experts, let's talk to the lender. But where's the line between where you can give them some information to look credible, but not but, or refer, just be like, hey, let's just talk to the lender. Is that just the easier route to go, is always just to be safe and say, let's talk to the lender? And I'm sure that also comes with time and knowledge, is like knowing the little bits and pieces you can tell them. But how do you know, tread lightly on what you can tell them and what you should avert to someone else, basically?
Here's what I would say. It's kind of like what I said earlier is when they are asking lending questions that are not just, you know, the different products and they want to go into detail like rates and that type of thing, or payments. I'm gonna say, you know what? What I do is help you buy a house. What a lender does is help you have the money to buy a house. So that's why I work with credible, reliable lenders, because that's their expertise. I'm not going to pretend to know all about loans, because that's not what I do for a living, right? So give yourself permission. It's kind of like what I said, Olgie, earlier, that you, when you're new, you feel like everything you don't know is because you're new. And that's not true. Some of it you shouldn't try to be the expert on. You just need this general information about what the different the overall different loan products, and say that's what a lender's gonna help you do. They actually do, and this is the other thing, and Jason's kind of alluded to it, but they're actually looking at a buyer's finances. A good lender is actually helping them make a decision on whether this is a good financial decision for them. They're not just saying, hey, let me get you a loan, let me get you a loan. And now some lenders do, and they're not having those thoughtful conversations about what someone can truly afford. But that's what a good lender is gonna do, and that's not what we do. We're gonna make sure that you're gonna buy a house at a good value. That's our job. So again, it's giving yourself permission as a new agent not to have to be an expert at everything, and having the script or the dialogue with your client that's why we associate with experts.
I think you've mentioned something about like client preferred vendors, and I kind of go that route because I've never used Loans in KC.
Mhm.
And when I do, but that might be 10 years down the road. I've only had experience with like Summit Lending, so I can't say, oh, my vendors, or so I always say my client preferred vendors. And that's incredible.
Yeah, absolutely.
Olgie, another good question you could have for the loan officer, if a client's using them, is if they've you can bluntly ask them if they've collected pay stubs and W-2s, if they verified the income piece. Because what you will see a lot of times out there is a lot of loan officers don't verify the income piece of it. And
Yep.
another thing that will lead to disaster.
Well, I say this about pre-approvals. Pre-approvals are a lender saying, this buyer looks pretty good. We think we're gonna give them a loan, right? Unless they have been gone under
There's
underwriting.
pre-underwriting, yeah.
Yeah,
Yeah.
unless they've done pre-underwriting, all they're saying is they look pretty good at this moment. But we don't know everything about them yet, but we think they'll be able to get a loan. That's basically what a pre-approval means.
Pre-approval letter doesn't mean anything.
Yeah.
I mean, really, at the end of the day, it's not binding. It is really based on the expertise of your loan officer. And it's only as good as your loan officer is at
And
the end
here's
of the day.
the other thing is they're all different. I actually wish there was a standard pre-approval letter that always had the information that we need as agents and that consumers should have. But they range totally different. So you're gonna see pre-approval letters of all shapes and sizes, and some will have a lot of information, some will have next to no information.
Do y'all have an example that y'all could provide for the launch agents of what it would look like a real life scenario?
What do you
even
mean?
Of just like a pre-approval, or what we need to be looking at on our end?
Oh,
I don't know, so just so you know, I mean, like, we can make the pre-approval letter say anything. Whether it's actually been done is a different story.
Okay.
That makes sense?
Yeah.
So, I
Like,
mean-
the first time seeing it
Yeah.
to be when.
But they're all different.
So I'll do
Okay.
this, yeah. So if anybody has any questions, if you cannot, if you want to work with Jason and you want to reach out to him first, no harm profile. You're not gonna hurt my feelings. But if you wanna meet with me one-on-one and you have these questions and we can show you these real life things,
Okay,
just text me or reach out to my email and we'll set up a one-on-one. We'll come in here and we'll walk through the whole thing. You can ask as many questions as you want. Again, my job is to make sure I'm a resource for you guys and KW Metro.
That's a good idea.
So,
So
yes,
that's
and I'll do that.
communication question. So I just talked to a friend yesterday and I hired her as a teacher a few years ago. And, you know, she's asking me all these questions and I'm like, great time to meet with. And it's from that email, that Facebook that I sent
Oh,
yours
you
out.
shared? Yeah, I
And
love it.
she's like, oh, do you work in Kansas?
Oh, I
and then
saw
I
that
called
comment.
her
I saw
the
that
next-
comment last night.
Like an hour later, and she's like, but my real question is, your contact information is all over. Who do you call? Like, you're loaded. You're not
It
as
would be
much,
preferable to call Shane for now. That's a great
That's a
thing.
great question.
It's
'Cause somebody,
it's preferable
you know,
to call
I
Shane
threw
right now.
your name out, but it's like,
And if that's too late to take that back, like I'll do
No, no, no,
I'll
no,
do
no,
my
no.
best.
not at all, very flexible.
I will be, I will say that my customer service is absolutely nowhere near where it needs to be right now. There's pre-approval letters I haven't followed up on in weeks. And so I would much prefer you to drown this man before I get drowned anymore. I'm already drowning. And my problem will hopefully get fixed here sooner rather than later, like. That's why I've spent 4 hours yesterday interviews and doing all that sort of
Yeah,
stuff, so.
it's again,
um,
startup.
Startup,
Yeah.
he's doing a lot of the backside stuff where he
Exactly.
can't just focus on the client relationship.
Yeah, I'm doing it.
So, but your information, I just
just call
screenshot
that Jay.
Jill.
I have one of these.
Yeah, just cross, so just like.
So Stephen, there's some koozies out in the area.
There you go.
on my desk with his contact
There
info.
you go.
There you go,
Uh,
bud. First
I wanna keep your drink.
So
But it's
loanskc.com,
on, yeah.
I'll get you, I'll get you
Yeah.
a file when we get down
Yeah.
there.
So
Well, sure.
loanskc.com, try to always remember that on the about us section or the team section,
Yeah,
like we have
that's
both
right.
of our contact info on there.
Use the app,
It's
Shane's on
nice to
there,
have that.
use the app.
yeah, and then Shane's in the
The
app
app
as
is
well.
fantastic, it really is.
But yes, so loanskc.com, we're probably gonna eventually make a generalized number and there might not be any individualized flyers with me on there and that sort of thing, like.
So, cause you're,
Might just
Right.
fade off into the sunset.
There you go.
Well, I mean, you just,
Girl, there, Jason.
yeah.
That's not how it was, the plane wasn't to go this fast.
I know, and I should have seen when I came on, I'm
It's a
like,
moving target.
yeah.
okay, so we
All right, we gotta
covered
get- Yeah, I was
conventional.
gonna say, we got.
We have until, we wanna wrap up before 11, so we.
Let's go on FHA a little bit,
FHA
yeah.
and VA.
Yeah, we'll go quick on FHA. So FHA, minimum down payment requirement. Who knows this one? Dominic, you know this one too?
30%.
Down
Serenity says 3, minimum down payment on FHA loan.
Dominic, text me.
Zero.
So we got 0, we got 5.
No,
Where's
3.5.
3.5? Ah,
Oh.
Dominic answered? No?
No, I haven't seen.
He fell asleep. All right. 3.5% is the right
Ding,
answer.
ding, ding, ding.
3.5%, Megan wins.
A koozie
Here's
for
a
you.
koozie.
There you go.
Koozie for you.
Or bagel.
You know, there are some down payment assistance programs out there for it, but I'll just let you know, like. Almost all of them, you know, the customer is paying one way, shape or form.
Okay,
On almost all of them. And so it's not like this conventional, no interest, you know, that person's still taking a sacrifice on the rate. So there is like a FHA one that's similar, but the sacrifice they take on the rate is significantly higher.
Okay.
So I think we have one that's at like 8.25 right now for the primary rate. You get literally a free money for the down payment. So 3.5% free money.
Free money.
But the rate on that loan is like 8.25, when the rate on an FHA loan is really like 6.5, 6.75, right? So it's a significant sacrifice in the rate that they make
that's a lot.
to get this free money.
Mm.
The other ones many of them have, you know, where they're taking the second mortgage rate is like 2% higher than the first mortgage rate, and so oftentimes there's still payments and interest paid on these loans, and it's not to say that they're all terrible, but there's almost always a higher first mortgage rates. when you're coupling it with some sort of down payment assistance program. So again, they can do their own money, always the best case. Who knows the minimum credit score requirement on FHA?
Okay, I'm watching online.
I feel like it should be higher, but,
Higher, why higher?
well, cause the percentage down is higher. She said 620 with conventional.
620 with conventional. So here, let's get some background. FHA, Federal Housing Administration, loan program created in the 1950s by the government to make homeownership affordable for more people. So do you think then it should have a higher?
Oh, definitely not. Thanks for the history.
Changed her,
Yeah,
Maybe
that's a
like.
great way to put
Wait a minute,
it.
I've got a new message here, let me see what. Dominic said, let's say 580.
That's what I was thinking.
Love it, okay.
Is it 580?
All right, so this is where we're gonna get complicated.
So right, take notes.
Complicated.
So it's-
580 is a good number, a good answer. So most lenders will go down to 580. 580 is kind of a magic number. Basically at 580, the borrower can still put 3.5% down and sometimes get an approval through a computer system that all lenders have to use when we pre-approve somebody. It's called an automated underwriting system. Every lender in the nation has to use it for conventional FHA and VA loans. There's two of them, one created by Fannie Mae, one created by Freddie Mac. So there's two systems in the country that every loan gets ran through when a lender is officially trying to pre-approve somebody. We need that system to say yes, and it's a very important system. It's reading everything on the customer. So at 3.5% down, 580 plus credit, that system will still sometimes say yes. FHA will go lower than 580 on the credit score. They can go down to 520. However, in order for the computer system to say yes, they must put at least 10% down when they're under a 580 credit score to even have a conversation really about getting anything. And what I will say is, you know, this kind of goes back into the conversation of whether somebody should buy now or wait, and can we take into account, you know, the benefits of owning a home and those sorts of things. So I talked to a lady yesterday that was 599 credit score. She was putting 10% down, and FHA was the only option. Conventional wasn't an option. And I was, even though the computer system was saying yes, like I was very nervous whether I would give the loan maybe a 60% chance that I was gonna go through. Like she had so many late payments, most recent one being like March of this year, then there was January, then she had a bunch at the end of last year. Like, so within the last 12 months, she had many late payments. I'm just like, I don't hear. The computer system was only saying yes because she was putting 10% down. If she was putting 3.5% down, it would absolutely have said no. So I would have been skeptical that it would have gone through anyway. But my point, I guess, is when a client has under 620 credit, the costs that they incur to even get an interest rate option can be pretty significant. So this lady yesterday at 590 credit.
Can you say that anybody
So
under
anybody under
620?
620, yep, even if the lender can do the loan, they are always paying a premium and extra costs to get that loan.
And that higher rate also,
Higher, yep, higher rate and more discount
and the
points.
more costs.
Yep.
Cause it's a risk assessment.
Sure.
So, you know, that's where as a loan officer, when, you know, we don't wanna say no to an agent or, hey, this really, like, this person shouldn't buy a house. Like, we know everybody needs to make money and sell, you know, homes and all those sorts of things. And so I don't really try to steer somebody in a direction. I will educate them as to their options. I will maybe let them know that, hey, if your credit score is 640, here's what you would be at, right? And so sometimes I will give them that education so they can see the differences or understand. And then they get to make whatever decision's best for them. Go ahead.
Along that line, does Loans and Casey help people with improving
That
their
was my
credit?
question.
So we have a pretty good resource though. I mean, I like the guy that did the first time home buyer class with us earlier this year. So Chess Inc. They're one of the only non-for-profits in the city, so they have a really reduced rate for like credit repair.
Okay.
For somebody, basically it's like $250 and they'll walk them through a whole credit journey.
What they called again? I missed
Chess
that one.
Inc. And we have contacts for it, so just let me know.
Chest.
Chess,
Chest.
CHES. Inc. And Kevin's the guy's name contact that I have over there. I can't remember his last name.
Dominic says, yeah, I like Chess Inc. Good guys.
Yeah, you know, love it.
And they help, cause that was the person I talked to, that was one of their questions, is just trying to get
They'll help
a
with it all, so they'll. take
little
them through
better
a
in
full
their
training.
financial setting.
Yeah,
And a bank didn't help them.
yeah.
They just
Well,
went in.
It's a,
and
it's a
said,
little
"Oh,
more
yeah."
thorough, cause they do get some grants from the government, and so they do have a little bit of a different intake process. I mean, it is much more thorough than
Mhm.
just being like, hey, pay down this card, do this, like. It's not a quick fix credit thing, it's kind of more of really kind of financial education almost.
That's wonderful.
And it's a bit more of a build process. You're probably, you go to Chess, you're probably looking at 3 to 6 or 6 to 12 months before you're gonna be in a financial position to purchase a home or put yourself in a better financial position from that 580 score, which is gonna be usually a half, I would say 0.5%.
Oh, I mean,
Or
I saw,
maybe worse.
I'm gonna get it wrong, and I can probably pull it up on my phone, but I wanna say that.
It's a big difference.
So she was $5.99, it was gonna cost her 1.5 or so
Mhm.
to get like 7.25%.
Right.
Something like that. So 1.5, that's 1.5% of the loan amount that we're charging them in extra fees to
Mhm.
even obtain that loan. So on a $300,000 house, that was $4,500 extra dollars that I had to charge her to get like a 7.25 rate.
Mhm.
If her credit was 640, so she's at 599, she gets 6.5%, so
Mhm.
0.75% lower.
Yeah.
Makes
With
a
no points,
Right.
so 0.75% lower and $4,500 lower in costs.
Mhm.
If her credit would just have been 640 or above.
Are those points discount points?
Discount point,
Okay,
yeah,
got it. And the seller can help with that, right?
they can.
Okay.
Yep. So they're considered, they're just added to the category of closing costs essentially.
Okay.
They're kind of separated out a little bit, so that way you can see them a little bit better. And they can't really hide, sometimes they can still hide them in their generalized cost breakdown, but on the loan estimate, they can't hide those things. But yes, it can be, just like any seller concession can go to the generalized closing cost.
Going back to the credit repair just for a minute, I know that Shane just said it could be 3 to 6 or 6 to 12 months. I will tell you that, at least from my experience, that's a lot less time than what the consumer thinks it'll take to repair their credit. So some of them are actually so surprised that they can make traction with their repairing their credit in 3 to 6 months.
Mhm.
So, and since it is a process that is counterintuitive, they need to be with a professional because they can screw it up more
Yeah.
if they try to fix it themselves. Because what they think will help doesn't help, doesn't make sense to me, but that's why, again, getting them with a good professional, it can happen faster than they think. It
Mhm.
really
For
can.
sure. And we can fix credit to a certain extent. We've been doing it long enough between the two of us.
Mhm.
Now, in all honesty, a lot of times we won't truly have the time that's gonna take to help them fix their credit. We can give them the right direction, but we're not credit fixers.
Right.
That's not what our.
Yeah, and it costs us extra money, like, I'm not gonna
Yeah.
follow up with somebody in 3 months and pull their credit again, see how it is, like, it costs us money every time we do that from an overhead standpoint, like, it's
Right.
not something.
Yeah,
that-
it's not something we can do.
Alright, I'm gonna fly through real quick.
Okay,
unless we got questions.
one question though, Dominic has a question. Are you seeing a positive or negative impact with student loan forgiveness? As far as on credit?
You know what, I honestly haven't, I don't know that I'm aware that I've seen it, and maybe it just gets removed from the credit report, or maybe it just is down. Cause when a lender pulls credit, all of the trade lines, all the debts with balances are at the top.
Mhm.
And all the rest are just at the bottom. And so I might scroll through a credit report to see if there was any late payments or derogatory stuff on things, but I'm not looking at anything that doesn't have a balance.
Gotcha.
And then what pulls into the lender system to calculate against the debt to income ratio is only the debts that have balance and, a balance on them.
Gotcha.
So we're not even seeing a lot of times the ones
Okay.
that have been paid off or don't
Okay.
exist anymore.
Cause they're out of your view line.
Yeah, and it's kind of irrelevant on the mortgage lending side of it. So Dominic, I don't know that I've seen that,
Any-
and maybe it's existed and I just haven't known that it was there. So
Mhm.
nothing that's been negative that has like been,
Okay.
apparent that I was
Okay.
dealing with.
Okay, let's talk about VA.
No, let's finish the FHA.
Okay,
We're
finish it.
gonna, we're gonna, yeah, no,
Run
I'm
to
flying,
VA.
we're just gonna knock this out, sorry. Okay.
Good conversation, good info.
So 580 credit score or above, sometimes you can go down to even lower with a larger down payment. Debt to income ratio, so again, program to make homeownership more affordable, so. You can go higher on the debt to income ratio, 57%. Megan's gonna be really excited about that. 57% on the debt to income ratio on an FHA loan. FHA is most ideally suited for customers that have average to below average credit, or really need to push the limit on their budget because of debt to income ratio issues. FHA is much less credit sensitive than conventional. So somebody with a score in the 600s, that interest rate will absolutely be better than the interest rate on a conventional loan. And then FHA's mortgage insurance is based off of the loan amount and not credit score at all. So on conventional, it was based on credit score, debt to income ratio, and down payment percentage, whereas on FHA, if somebody's buying a $200,000 house, put 3.5% down, whether you have 680 credit or 620 credit or 780 credit, their mortgage insurance amount will be the exact same on an FHA loan. Whereas on a conventional loan, that would easily have $100+ a month difference.
And on the FHA, the PMI is permanent.
So let's talk about the downsides to
Okay,
FHA.
yeah,
So benefits of FHA can be very competitive in rate and payment for somebody with average to below average credit. Can help somebody qualify for a more expensive house than what a conventional loan would allow. The downsides to FHA. There are 2 mortgage insurance premiums. 2 of them. One that gets added to your monthly payment, just like a conventional loan. That one, if you put less than 10% down, it can never go away unless you refinance out of the loan program. If you put more than 10% down, it can go away after 10 years.
Okay.
So they have 2 mortgage insurances, a monthly one that may or may not go away. And then they have an upfront one that they charge at closing, very similar to a VA loan and the VA funding fee. So it's 1.75% of the loan amount that they charge, and it's the only cost that can get rolled into the loan amount at closing. And so what is really happening is a borrower is putting 3.5% down, but then when they walk away at closing, they only have 1.75% equity actually in their home because the upfront mortgage insurance ate up 1.75% of the equity they built in the home. So while FHA does have some downsides financially, it can still make sense to do over a conventional loan because the payment savings can be pretty substantial. Because the rate will be lower, mortgage insurance, monthly mortgage insurance can be lower. And then as agents, you guys need to know, obviously on FHA loans, all the government loan programs, FHA, VA, USDA, they all have additional property requirements on the appraisal.
Yep.
And so handrails downstairs, peeling paint on the exterior, yeah, safety and health issues, peeling paint on the exterior of the house, and sometimes just the general deferred maintenance that hasn't been taken care of. So age of roof matters. There has to be a certain amount of lifetime left on the roof, peeling paint on the exterior of the house, window sills, door trim, all of those types of things can be flagged by the appraiser and has to be fixed prior to closing. And so oftentimes, you know.
Is there a list somewhere?
Well,
Sort of.
it's subjective.
It is, that's,
I mean,
Some of them will look by it and
Yeah.
so
Some
it'll be
will
hit or
mail you
miss.
one
Yeah,
every
yeah,
He said
it'll be hit or miss.
field paint, railings and over 3 steps or
Safety.
30, safety and health
Or
conditions.
18 inches off the
The
ground.
biggest one flagged out is the chipping and peeling paint.
Peeling.
For
FHA,
plant-based
VA.
paint, that's a big deal for them.
Yeah.
But it depends on that appraiser.
Yeah.
Some of them, like
Yeah.
Jason just said, they'll look over things and sometimes they won't. Here's the thing. If you have a buyer who has little to no money, do not show them a house that's in bad condition if you have a VA or an FHA.
Yeah, you need it.
Lender.
It needs to be in good
Okay,
condition.
it has to be in decent move-in condition.
Yeah.
If you're showing them shacks, if you're showing them fixer-uppers, they're not, the appraisal's gonna come back and the seller doesn't have to fix anything, okay? And they do not care who repairs it, but you do not want a buyer repairing something on a house they do not own. I've seen the ugly of that. Go.
We're gonna let Shane
Thank you,
finish.
thank you, thank you.
Yep.
Thank you.
Yeah, you're welcome, guys.
Thank you so much.
very
Absolutely.
helpful information.
Good
Yeah.
stuff. So keep in mind that you've got to be very aware, and also you have to look in MLS to make certain that that seller will accept an FHA or VA loan.
Yeah,
So do not go, because it happened to me as new, no one
Yeah.
told me this. I got all excited, showed my buyer a house. And then they're like asking questions, and after we saw it, and they had some interest, after we saw it, I saw, oh, they don't take
Yeah.
FHA loans. So be careful, don't assume that every seller, every house is gonna take an FHA or VA, and there are also purchase price limits that go up every year on both of those.
Mhm.
I don't even know.
Conventional has that also,
Yeah, you
so,
can't.
Yeah.
yeah, so purchase price, it puts us into a different category.
Mhm.
What do we
Um,
need to know about VA in
I wanna-
5 minutes?
One thing I actually want to say one thing too. So remember, everybody, when you do have a down payment, your minimum investment has to be met in that in that home. So if it's FHA and you have to put 3.5% in, 3.5% has to come out of the client's pocket, no matter what. Even if you get the seller pays or you have the seller pays closing costs, very important that that money has to come out no matter what. 3% conventional has to come out of the pocket, 3.5 for FHA.
Okay,
You cannot go below that threshold, because that's actually happened in the past and it messed things up, so just that. VA, it's my favorite loan, I love working with veterans, so, I work in Leavenworth a ton, I actually have 3 VA loans going on right now. So it's my little soft spot, my way to give back to the veterans, because I didn't, serve, but basically the VA allows 100% financing. And it has no mortgage insurance. It's the best loan out there. In my opinion, it's my opinion by far. It helps the veterans and it is a benefit to the veteran.
Yeah.
So they allow the guidelines to move and stretch a little bit. And VA also, what do you think the lowest credit score for VA is?
Cause this
Anybody
is to
know?
help veterans.
Because it's a
I'm
benefit,
guessing it's the 520 then, if it's the lowest.
500,
500.
yeah.
Wow,
500 is a good-
500.
Okay, so those of you, it's 500 online, so Zoomers.
Now, but again, now, that's same rule still applies as FHA. If you go to 500 on a VA, they'll probably make you put 10% down.
Okay,
Okay, 580 is still that threshold for doing 100% financing on a VA loan.
So there could be instances where a veteran is doing a down payment.
Yeah, well, they have to, anything under 580.
Yeah.
We're still at the same underwriting conditions that we talked about earlier. Through the underwriting guidelines that we follow, so they'll do 100% financing. The veteran, so they'll have, anybody know what else goes along with the VA loan on this? Mentioned the upfront mortgage insurance, you mentioned at 1.75%. VA has what they call a funding fee, okay? There's only 2 options for whether they have it or not. If the veteran is a disabled veteran, 10% or more, then that funding fee is waived. Okay,
okay,
if it's not waived, the first time use is 2.15%. And that does get financed into the loan, so if the finance fee is 2.5% or 2.15%, then the loan amount starts at 200, then that final loan amount is payment is gonna be based off of 204,000 and some odd change, right?
okay.
So I don't wanna get too technical on that, but there's a funding fee, it's either there, or it's not, 2.15%.
That's the first loan. What if they're a VA,
If
get
they're,
the
if
second
they're,
loan?
if they've ever had a VA loan before with no disability, it turns into a big number, then it's 3.3%
Wow.
for subsequent use on a VA loan.
Okay, so we have 1 minute.
Yep.
Here's what I'm going to propose. We're gonna bring you back to talk more about VA.
I'm
Because-
sorry, what's that last figure? I'm sorry,
3.3%
3.3.
for subsequent use.
Now I want you to get the right information.
And again,
So
reach out
those
to
of
me.
you on Zoom, do you have any last
Quick question.
questions, quick ones for Shane? Because we need to head over to the red class. All of us do, either if you're online, then go to the closed office Facebook page, or we're gonna physically take our ourselves over there. Anybody online have any questions? This was a lot of
It
information.
is.
Thank you for the
Fire hose.
insight, says Dominic says, thank you for the insight. Yeah, a lot of great information. Again, we don't expect you to
Good job,
remember
yeah.
all of this. This was to give you, a lot of information and give you overview of some of the main loan products out there. But that's why you partner with experts. I can't say that enough. Do not be the expert on loans. Be someone who has good general information, and then you've got great partners here to help you and your clients. And that's what we want. We want our clients having good, real information as they make these big decisions. And the type of loan and the lender they go with is a big decision. So we so appreciate Loans in KC. Here's the great thing is, unlike other lenders, you're probably not gonna wanna confess you're new to an outside lender.
Don't.
Because they're not gonna always want to hold your hand. They're gonna think, oh my God, Stephen doesn't know what he's doing. This is gonna be painful to work with him. Loans in KC has a vested interest in
Well, or the
us.
main.
And so they're willing to educate you and take you
Yep.
through this process. So they really are our partners, and you don't have to worry with all the questions. Because actually, I like the questions.
Yeah, actually, I enjoy educating
Yeah.
too.
Yeah.
So again, use me as a resource. If you have questions, even if you work with another lender and you think, okay, that's a suspect,
Yeah,
reach out to me and
bounce it off
we'll
of
find
them.
out. Yeah, we'll figure it out for you guys and help you out. Because we really have vested interest in you guys succeeding too.
100%.
If you succeed, we succeed. If we succeed, you succeed.
And then your clients succeed,
And
and that's
at
our
the end of the day,
ultimate
that's the
goal.
goal. Yeah.
That's the goal. Well, thanks you guys, everybody online. Thank you for being here and getting this great information. And Shane, tell Jason he did.
I'll
a
tell
good
Jason
job.
thanks also. He's very affluent.
Okay,
and very-
talk to you guys later.
Bye, guys.
Thank you.
Thanks.
That's what